Hello and welcome everyone for another Facebook Live here today with Stashaway. I have with me again my fellow employee and our Chief Investment Officer, Freddie Lim.
Hi.
And today, I know it's a day early than we usually do on a Friday, but I will be out of the office tomorrow, so we decided to do it today and give a little bit of an update here for everyone, kind of what has been developing since last week. There's a lot of chatter in the news right now, so I want to address a couple of those items. I think we'll talk a little bit about the Federal Reserve, see how companies are doing, and give a little bit overview of is there any change in the economy itself. And then we'll wrap it up with some recommendations on what we believe are the things investors should be doing at this point in time, right?
Right.
So as always, please feel free to ask any questions in the comment section down below the video. So we'll definitely try to get to them today.
Mm-hmm.
And if not, one of our customer support team will reach out to you and answer them, or we'll address them another time next week maybe. But anyways, let's go right into it. Freddie, kind of maybe you can give a little bit of an overview. What's been, especially after yesterday, markets dropped more than what we've seen so far this year. A little bit in like January, feels like end of January, early February, right?
Right. We've seen the third largest drop in a single day this year, but in the grand scheme of history, it's just a blip. So I would caution investors from overreacting. That's the first message I want to send.
Yeah.
Let's talk about what really happened.
Yes. Yeah.
Two things are really driving this market reaction recently. It started with the end of September when the Federal Reserve completed its meetings, and there was some confusion as to how the message was being delivered.
Yeah.
So in particular, you have a situation where the Fed acknowledged that the inflation is tepid. It also acknowledges, they also removed the word accommodative from the official statements, which means that they knew that policy is now tight, which led a lot of market participants to interpret that they will slow down the pace of rate hikes. But immediately after the release of the statement, Chairman Powell in a press conference contradicted the statement and said, well, it doesn't mean the Fed will not go above neutral, don't overread the statement. So it's just a really weird communication. And one really can't help but felt that is this tantrum have anything to do with Donald Trump's complaints?
And I think this is a really interesting point, right? I think the reason why this is also so much bigger than it has been in the past when rates have been tightened, or like they started tightening and rates were being raised, is that we have a president right now that likes to talk and give his point of view, right? And he does it in a very well. Go back in time. How does he come back up? He's a real estate guy, so he likes
exactly
leverage
right.
and low rates, right?
Central bank's independence has historically been sacrosanct, but Donald Trump has just turned that around by publicly criticizing the Fed on their interest rate hikes decision. The main issue here is not whether the Fed hike interest rates. They're doing it gradually. Communication so far has been clear. The market were well managed. There were no hiccups until recently.
Yeah.
So in a nutshell, it might be the case where the Fed is trying to demonstrate independence, and perhaps in its communication overshoot the policy bias. I don't think it's intended, but the market has not taken it very well at all.
No, but you have to, for all the listeners out here, I think it's very important to also, even bond prices move quite a bit in the short term, right? As you can see now, they can spike up and down, right? It's the same with equity prices in the short term though.
Yes.
So for long term, they normally smooth out and go back to their averages, right? But just to put it in perspective, this can happen on the bond as well as on the equity side.
Yes, absolutely.
So with that, kind of like what has happened on the Federal Reserve and interest rate side of things, right? How about company earnings? Because I think especially the tech names have been in the news the last week.
Yes.
So maybe you can shed some light on that.
Well, there's something that's very important going on the stocks side, concurrent to the bond route, which sort of compounded the market reaction. So number one, a lot of companies have proactively tried to guide analysts' earnings projection down. Why would they do that? Well, it's quite psychological, really, in the sense that company earnings have been beating analyst projection for a long time, to the point that analysts are looking really bad all the time. Imagine if you're wrong all the time, you are always stating the earnings. There's this bias where analysts started to raise their earnings expectations to ridiculous level. So this sort of bias is what companies are now very concerned with, and they are responsibly trying to guide it to a realistic level. And of course, that makes up for a very good, sustainable investing environment in the medium to long term. But in the near term, the analysts weren't happy, and you have lofty expectations, so the market reacted negatively as well.
Yeah.
Yeah.
So does that have any impact? Is this all impacted also by the trade war, or do you think that is completely discounted in already before we had the last week happening?
The impact of the trade war hasn't really shown up as much. Some companies did show some impacts,
Yeah.
but the full impact is premature. But what has been already priced into the market is a lot more than what's happening in the real world. As you know, markets are forward-looking, and market are expectant and always try to guess going forward. So a lot of trade wars impact have already been priced in, really.
Yeah. No, I think that you're totally correct on that as well. So with that being said, so we covered kind of like the Federal Reserve part, we covered kind of what happened to this tech stocks, especially tech stocks, but company equities in general.
Mm.
So then from an economic perspective, right?
Mm.
Is it actually that bad, right? Like everyone says now, oh, the economy is slowing, China is slowing, this is slowing, but is that actually the truth?
Not at all.
Yeah.
I'm sorry to disagree with the media, all the sensational headlines.
Yeah.
We disagree because just look at the data.
Yeah.
Look at leading economic indices produced by the U.S. Conference Board with some of the most high quality and long dated time series you can ever find. It's just an astounding number. The leading economic indicator for the U.S. have been growing steadily at 6.4% annualized rate the entire 2018.
And you have to think about it. There has never been a recession
That ever happened when the economic indices are, or the leading
and
indices
still
are
growing and are still showing positive signs. There's never been one. So I think this is people need to focus on things that you can actually like look at and paint a picture on and not get distracted by all this noise, right, that is in the market from the things we talked about before. But so what are some of the things that you believe strongly about what people should be doing? Because a lot of people are worried about, oh, the markets are dropping again. We just went through this in January. We thought it was over, and we had new highs, right? Kind of what are your kind of like your takeaways for people that are listening today?
Well, number one, don't overreact.
Yeah.
You already have committed to a long-term investment savings plan.
Yeah.
You continue to do so because doing so when the market's down improve your reward to risk ratio because you're getting into the markets at cheaper prices. The economic cycle hasn't changed, so you're actually getting a bargain right now. So stick to your plans. Don't overreact. That's number one.
Number one, okay. Yeah, and you just talked about the economic cycle hasn't changed. So where do you stand on inflation? Because I know this is also in the news because of the Fed and Trump and some of the things, right? So and oil price is higher, right? So
Yes.
this is kind of starting to impact, especially Americans now, for the midterm election, right? It's starting to get more impact, and I think this is why Trump is also trying to talk about like.
Exactly. Inflation, there's really two parts to inflation. When you look at intermediate goods and all that fits into consumer products, that's what we call downstream inflation, and it's more related to commodities. And yes, it's true that oil price gone up, and however, a lot of other stuff like natural resources, base metal, precious metals are down. When you make a building, a lot of base metals are involved.
Yeah.
It's not just the oil price. So overall, the commodity complex as a whole hasn't really done much. Although there's a lot of noise about oil price being high, but base metals on the other spectrum. So I would say if you focus on the effect of the transmission effect to downstream inflation, it's actually quite low. And oil price has a year-on-year effect. So you may see a year-on-year impact like this year's price versus last year. It's gone up a lot. You see a one-time increase in inflation, but then it knocks off after that. So just bear that in mind when we think about those commodity prices. On the other hand, on the I think this is called upstream now, which is more related to income and wages. They have grown slightly, but not alarming.
Not alarming at all. No, I think they're still within the 2% range.
Exactly.
Right? So it's nothing.
We structurally have a new economy with a lot of innovations, disruptions. People are finding it, wages aren't rising because of productivity with technology and a transition to new industries. Structurally, it's hard to see wages blow up like 1970s. So I wouldn't be alarmist here.
Yeah.
They are rising, but they are not cause for concern. And I just want to clarify, inflation going up may not be a bad thing at times because it signals that people are making more income. And so with a growth picture being intact, some rise in inflation is not a bad thing.
Yeah. No, I agree, totally agree. And one of the other recommendations, that we thought of too, right? It's just stay focused on real economic data, right? Like you said, you just mentioned the leading indicators, right? They suggest everything is still going strong, right? Bull markets have never ended when the leading economic indicators were pointing upwards and positive, right?
Yes.
So they normally end when people get too cheery, right? Right now, no one is cheery. Everyone's actually gloomy. So normally it's when they're cheery and when they overlook these indicators, when they're slowly starting to weaken, right? This is when you kind of need to make changes to your portfolio. But so anything else that you would like to add?
It's a very interesting topic in a sense that human feelings are almost always opposite to what they should do. In the sense that, for example, in a good economic times and bull markets, it's actually very, very common throughout centuries of data to see a lot of little declines of 5 to 10%. To be even more meaningful than that, something called corrections. The market has to fall 10 to 20%. And these things are actually very common and mostly happen in the bull markets. In a bear market, it's very different. They don't start with a bang, they whispers, and they are almost always driven only by economic slowdown, which is not the case here. So I would really want to caution investors from, again, overreacting to the fight or flight response, because that works in the real world, but physical world, but doesn't work in the financial world. So control your urges, stick to your plans, and stay long term.
Stay long term. Yeah, I think that's a great way to wrap it up, right? So maintaining your diversified portfolios, continue to buy growth, and hold your assets over time. Have your long-term goals, right? Don't forget them just because the market has dropped by 4% one day, right? This is like one of the things. Keep your long-term goals because you will need growth, right? And the trade-off that is some volatility over time.
Exactly, which is why to help ourselves to not overreact to markets, we always still need to buy some protective assets that's not going to do well in good times, but they provide precisely at this moment, they provide you with those much needed protection.
Yes.
And so keep risk in focus, stay true to your plans, buy protective assets some protective assets even in good times, right? So those boring truths are the only truth that keeps you successful in the long term.
Yeah. Well, thank you, Freddie. I hope everyone here, had something to take away from this, and hope you liked the overview of what kind of give you some details on what happened over the last few days and over the weekend. So thank you again, Freddie, for taking the time. If any of you have any questions, even when you watch the recording, maybe tomorrow or even over the weekend, please feel free to reach out to us. You can call us during business hours, normal business hours, or you can email us at support@stashaway.com, or just write your question or comment in the section below, and we're happy to answer them. Thank you so much again, and have a wonderful evening today. Bye bye.